Hello and welcome to Options Guy TV. My name is Brian Overby. I'm the author of the Options Playbook. And this week's theme, we're going to kick off where we left off last week and talk a little bit about Nvidia. And we're going to look at a way to adjust the trade that we looked at last week. So when you think about Nvidia, there's a lot of hype in the marketplace, and maybe rightfully so. Everybody, unless you've been sleeping under a rock, you you wouldn't know that Nvidia stock price has basically gone up about 240% since the beginning of this year, and it's all because of this wonderful chip that they have that will help the AI scenario, artificial intelligence, be built out throughout many different platforms and basically all across the world. So the demand has been extremely high for this chip. It's driven Nvidia's stock price basically perpendicular, but they announced earnings last week. And after this real strong move in the underlying stock, it's a little pricey, but relative, they have earnings. It's not like back in the day when Tesla was basically the stock was just skyrocketing and they had no earnings at that point in time, and nobody knew where they're going to go to next. Nvidia has always had earnings, well, I guess for quite some time, and now they're actually trading at about a 42 or 43 PE ratio. And a lot of people are saying, well, that's all right because they have this new chip and nobody knows where AI is going. So going into the earnings after such a real strong move, it obviously had to make you nervous. The buy the rumor, sell the news scenario, they blew the numbers away just like they did last quarter. Last quarter, they blew the numbers away and the stock took off. This quarter, they blew the numbers away and Nvidia opened at a new high, actually ran up and touched above 500 for like a millisecond, and then started selling off during the day after their earnings announcement. And lo and behold, at the end of the week, they were actually negative and actually had a negative week, which is the first negative week it's had in many weeks in a row. So their earnings announcement, the people that own stock took this as an opportunity to actually sell off and take a little bit of profits. So people are still extremely bullish on Nvidia. I'm not going to give an opinion on it. The stock is so volatile that it's really hard to try to judge where it's going to go to next. So I don't want to have to judge. I'm going to pretend here that I don't have a position in Nvidia. And I'm thinking about dipping my toe in the water. We had the big run up, a little bit of a sell off, a little bit of a fear of missing out scenario right now. And that maybe you missed in a lot of the upside movement in Nvidia, just were too scared to jump in and actually take a position. So last week, we took the same concept and actually put together a zero cost collar. As a matter of fact, we did that collar for a net credit to the account of 60 cents. So we looked at buying the stock, buying a protective put to limit our downside, and selling a covered call to help pay for that protective put. So the gaggle of options, the put and the call, actually didn't cost us anything. It was a 60-cent net credit to the account for putting on the trade. We obviously had to pay for the stock, and we have a lot of risk that's involved with the stock, but we limited the risk by using the options. Now, in order to get that done for a net credit of 60 cents, basically putting on a protective strategy so that we can participate in Nvidia without all the risk, even though we'd still have to put up 100 shares of stock. So you're still talking about 40. Right now it's at Nvidia's at 456. So you're talking around $45,600 to be able to buy 100 shares of stock. But if you put it on, you would had our downside, I think, was right around 7%. And I think we had about 11% upside. I actually got it in my notes, but that's my recollection. All right. So we went out to the October 20th expiration date. That's what we were looking at. And we did this collar. And I promised you on Friday's show that I would come back and find a cheaper way to do it without putting all that capital into the marketplace by buying the stock outright. What's a way that I could participate in this underlying stock and have limited and known risk to the downside, but not have to put so much capital in? And there's a synthetic trade, and synthetic means basically similar, the exact same risk reward ratio as the zero cost collar. And it's quite simply a long call spread. And so we're going to look at a long call spread in NVIDIA today. All right. So I've basically gave a very long summary of the show. So let's get into it. I'm going to start by looking at, well, here's the chains on NVIDIA. We see that NVIDIA is down today. Once again, it's down $3.70 or almost 1%. I'm going to pop over to the chart real quick, and I'm going to zoom in on what has happened since the earnings report. And so I'm going to grab this little corner here, and I'm going to actually put that gap into it. All right. So here's the big gap up from the last earnings report coming all the way back up to this quarter. And we saw on the open, like for a second, they set an all-time high, which was right. Look at, where is that? 502 is where it is at. And that's going to be fairly important on our strategy. So I did want to highlight that because I am targeting that area of the strategy. And then on the downside, now ever since that earnings, it opened that high, closed basically flat for the day, which who would anticipate that they would actually close flat on the day after an earnings announcement. And now the stock is down. So if you even just look at what happened over the week, so they announced on a Wednesday, going into the announcement, the stock rode all the way up. And now at the very end of the announcement, so this is where the stock was at, that would have closed on at 470 going into it. Stock was actually down. It's and down a good amount, and not an amazing amount compared to the actual run up. But before the announcement, they're right at about 470. Closed down here on Friday about let's call it 450, 448, 449. So is this an opportunity, or does it make you nervous that we sold off? Well, if you're thinking about just, yeah, this would kind of make me nervous looking at this chart. One of the things that we do see here is we have the 20-day moving average kind of coming in and bumping up against the 50-day moving average. That's not too worrisome, but if we came down and tested this area right in here, that would make me a little bit nervous in the stock. We've still got some high valuations, but then again, nobody has any idea what AI can do and how it's going to change the world. So let's look at the trade. On the Trade Hawk options grid, we have the October 20th expiration. It's 53 days away. The reason why we're using this is we've been talking a lot about the VIX. As a matter of fact, we did a VIX option trade last week, and we're going to come back and we're going to look at that, just looking for more volatility as we go into September and October. Quite straightforward on that trade that we looked at. So we're kind of expecting some choppiness in the marketplace, just seasonality wise. So let's try to get through September and October. If you wanted to dip your toe in the water in NVIDIA. So we're pretending you missed out on the move. You want to get into the stock somehow, but you don't want to buy it right here with all the risk of buying 100 shares of stock at 45.58 or putting up that 46,000 almost in capital to do so. All right. So on our zero cost collar that we talked about on Friday, we sold a call, which gave up some an upside opportunity. The call that we actually sold on that was the 505 call. Once again, targeting that high where we were at on that chart. Once we got that big gap opening after the earnings announcement. And then we used those proceeds to buy a 420 put. So we own the stock. We literally said, if it goes below 420, Well, we're going to take our ball and go home. We're not going to play anymore. And we said above 505, well, you can take the stock away from me. I at least participated in some of the move on NVIDIA, and I'm okay because I'm selling it higher. Or maybe I could roll it, roll that option contract and try to keep the stock or buy it back and close it, however I wanted to approach it. So now with that in mind, that was a lot of capital, a very capital intensive trade. We're now going to go out and we're going to put on a long call spread. Now, I'm not going to do the zero cost, right? And zero cost, what I'm talking about is we sold the call and it matched the price of the put. As a matter of fact, we brought in a small credit. We are now going to try to worry more about the capital that we're going to put in. It does mean we're going to have to pay a little bit more time value for this trade, but it's going to be a lot less capital intensive to start with. And we're still going to target that $500 range. So I'm going to stay in the same expiration just so that we can compare apples to apples. And I'm going to look at where the stock is at. We'll call it 460. Nice inside the TradeHawk software that it highlights the most at the money option contract. And we're going to go down about 30 points in the money. And we're going to buy the 430 strike call. It's a very expensive option contract. Markets are fairly tight, tight for the options world, not for the stock world, but they're fairly tight. And we have an extrinsic, which is time value of $20.45. Now, if I'm trying to straddle the market, I'm going to pay a lot of attention to how much time value there is in that option contract, because when I go and sell my next option contract, I want to know how much susceptibility that I actually have to time decay, because that's the biggest battle in the option trading world when you're buying options flat out is what if the stock doesn't move at all and we go all the way to that expiration date, what's my susceptibility to time decay? And that means right here that it's $20. So what does this say to me? This says to me, I don't want to buy this option contract. I don't want to go out to October and pay all this juice, all this volatility premium. And it goes along with being an expensive stock and also that we have a fairly high implied volatility, right around 50%. So now we're going to give up some upside like we did with our zero cost collar on the stock position that we bought. And we're going to sell an option contract that's right near its all-time high. And we're going to go out to the 500 strike and we're going to sell one option contract. Now, this is an out of the money option contract, so it's all time value. So the intrinsic value is basically going to be what the price of the option contract is. Here's the ask and here's the bid. And we're going to sell a $16.60 option contract. Okay, so I'm going to try to grab the time here. So how much time value are we susceptible to? So we'll take 2065 minus 1668, and we have about $4 worth of time value, or $400 for every 1-by-1 spread that we're doing. Okay. If you want to try to get the time value less, well, you just got to give up more upside. We can go down to, if we wanted it to be equal in time value, we could actually look at the 490. But then we're going to be giving away some of this upside opportunity. And the chart was kind of saying that 500 was an all-time high, and maybe it'll struggle to try to get through that range. So I decided to do the 500 trade. And this is the way that I would look at it inside my account. But if you truly want to just deal with the price of the underlying stock between the strikes, so you take out that time premium component and you deal with that price. Well, it's very possible to do that by just saying, all right, I am going to sell the same amount of extrinsic value or time value as I'm buying. All right. This is going to be a little bit clearer when we go and we'll look at both of these trades inside the what if calculator. But to start with, this is going to be the official paper trade for the day. We're going to have a little bit of time frame. That means we're going to need a little bit of a bump up in the underlying stock to get to the break-even point. And we'll go through that. All right. So unfortunately, since I put the trade in, the stock has actually gone up in price. So now we got to pay 32.50. That's a good round number. That will be our midpoint. We'll say 32.50. So now we've gone from $45,000 or $46,000, we'll round up, to being able to participate in the stock. And here's where the FOMO comes in. And now for every 1 by 1 long call spread that we put on, we're going to pay $32.50. So 32.50 times 100 is $3,250. So let's divide that by 46,000. So now you're talking about 7% of the stock price. And the goal there with that 7% is to say, well, if I bought Nvidia, maybe I would sell it if I was down 7%, but that's really hard to do if it's going to be dropping precipitously to the downside, because you're going to get gap openings, you're going to get high volatility in this underlying stock. But by doing this, we're saying we're going to put up 7% of the capital, truly a FOMO trade. We're nervous about September and October, but also worried that we might miss out in this opportunity in AI and what's going on in Nvidia. We got a little bit of a sell-off. How can we dip our toe in the water? Well, this is one way that we can do it. Okay. So let me go to the what if calculator. I'm going to put this trade in the what if calculator. And before I do that, I want to let you know, as always here on Options Guy TV, we want to make this as interactive as possible. So if you have any questions regarding any of the trades that we talked about last week, even the VIX trade, feel free to put them in the comment section down below, and we will definitely address those on the show. All right. So I'm sending this to the what if. So this is the profit and loss calculator, or if the stock goes here, what if the stock goes here? What does this trade look like? What does this strategy look like? So once again, we're going to 500, which would be fairly close to its all-time high. From 500 on up, we don't participate anymore at expiration, which is the October, what do we have? The October 20th expiration. On the downside, from 430 on down, we don't participate anymore. Between the strikes, we do. So between 430 and 500, we participate in the movement of the underlying stock. Now, the stock is here at 458.39. Now, it's a moving target, and that's going to affect our break-even point. But I'm going to highlight this because I'm going to go back and I'm going to set up that other long call spread that we talked about, and you're going to see this line move. But where we're crossing the x-axis is at 462.48. So this, based off of the mid price of the stock and the theoreticals that are used within the calculator, we're saying that if we do this, we want the stock to at least get to 462.48 by that expiration date, because we have this time component that's in that strategy, and it was about $4 worth of time premium. Okay, so because of that, that's where our break even is at. So if we roll this all the way to expiration, if we put this trade on right now, the green line is our profit and loss graph. And as time erodes, that will morph into the yellow line as expiration approaches. So to start with, if the stock does go down, we have less risk, right? Because if you look at where the green line is at, that's taking implied volatility and all the time premium, and that's as of today. So to start with, less risk on the downside, but also less gain on the upside. We really need to start getting deep in the money before we can get the maximum out of this trade. So you need some time decay to happen if you're going to be correct on your trade. It's part of the reason why we didn't go out as far as January, right? We wanted to get through the volatile period, and that's why we picked this October 20th date. But we also need some time decay to happen, because we protected ourselves by selling a call option, giving up some upside to help pay for the deep in the money call option, or with the zero cost collar to help pay for our put option that gave us protection on the actual underlying stock. Now, if you had the collar and you had that position on and you looked at it inside the profit and loss graph, you would see that this is an extremely similar profit and loss graph. You can even make the argument that it's exact. Now, there might be a little bit of difference in the break even and all this, but the math actually works out that you're synthetically going to have the same amount of risk by buying the stock, selling the call, buying a protected put, versus using the same strike prices and doing a long call spread in that scenario. All right. So let's go back and look at this. Now, I want you to pay attention in this area from where the stock is at, which this is the last trade, and where the break even is where we came in on this trade. And we're going to change that up. We're going to try to move this break even over here a little bit more. But guess what? It's going to cost us some more money in order to do that. So our total risk right now is $3,250, about 7% as compared to buying the stock outright. Now let's get rid of this leg. Let's look at the extrinsic value on this to 2070. We could sell this. We're going to come really close to that, or we could sell the 485, the 490 or the 485. I'd rather pay a little bit more in time premium and buy the 490. So let's do it. So let's put this in or sell the 490. And now if we go and I'm sorry, that's right. We're giving up some upside. So we actually lowered our cost basis. So now we're looking at $29 as our midpoint. We'll keep that off. Its midpoint is $28.77, $29. But we've given up a little bit of potential upside. So in this instance, we're paying $29 for this spread. And if we put this in the what if calculator, now we're going to look a lot closer to where the current stock is at. Why is that? Why did this gap between, and I'm highlighting it here on the screen, the gap between where the stock is and where we cross that x-axis gets smaller? It's because by selling a more expensive, closer to where the underlying stock is at, by selling that option contract, now we've sold almost as much time premium as we bought. If we get it down to zero, guess what happens? The break even lands right on where the stock price is at. And then you truly have a situation that you're only participating in Nvidia between the strike prices. And it's all about the movement of the underlying stock. And if you ride it all the way to expiration, you have no time premium exposure. And hence the reason why we go a little bit in the money on this scenario, on a FOMO trade, fear of missing out, and then buy some intrinsic value, some real value, and then sell a little bit out of the money option contract to try to straddle that stock and create the situation where we're selling as much time premium as we are buying. Now, if you have any questions, feel free to put them in the chat box and we will try to address them. Okay, so that created a question in my mind. So I have a question like, why wouldn't we sell this option contract then, based off of everything that you just said? And here's the reason why. I want a little bit more upside. So I'm willing to take in a little bit of time premium exposure as opposed to the 490. I liked where the chart was at, and we looked at that 500. So here's the difference. The maximum that this spread can trade for is the width between the spreads. So from 490 down to 430 is 60 points. We're paying 29 for it. So that also kind of works out that if we truly get rid of the time premium, right? In other words, we buy as much time premium as we're selling. If that works out that way, well, then if it's a 60-point wide spread, we should pay $30 for it. It should be a 50-50 trade. I'm risking $30 to make $30. So If I'm dead wrong, I lose $30 or $3,000 on my 1-by-1 spread. Or if I'm right, I make $3,000 on my 1-by-1 spread. Now, we didn't quite do that, right? We came off by about $1. And guess what? That's the difference. Paying 29 for this on a 60-point wide spread, that means that our max risk is 29, $2,900, and our max upside is 31. But the stock doesn't move at all, we're going to lose money, right? Because we needed to go up at least that dollar's worth of time premium in order for us to break even on that trade. Now, here's the difference. If we change this up and we clear this leg and go back to our, sell that one, we're going to go back to our 500 strike. Now, we're going to have to pay more for that, but here's the upside on it. You go from 500 minus 430. Now you have 70 points worth of upside. We're going to have to spend a little bit more on our option contract. 32. Well, the market's really moving here. As a matter of fact, it's already taken back all of the gains or all of the losses that it had on the open. So it's changing everything up on the math. But so now we're paying about $32.90 for it on $70. So our upside, we'll call it 33. Let's make the math simple. So now our upside is $37 and our downside is $33. Okay. And we'll put 33 right in there. Okay. But you're going to have to act fast, right? Because the market's moving. If we look at this right now, the market's actually flat from down from where we were at. But now we have exposure to time premium, but we have more upside on the trade. So there's the trade-off. Therein lies the trade-off. We got to pay a little bit more, we got a little bit more risk, but we got a little bit more upside. And remember, we're targeting that 500 level because that's the new high that was just recently hit in Nvidia. So we're looking at the chart, and that's part of the reason why we're selling that 500 strike call. So move it either way that you wanted to. FOMO trade, fear of missing out. You could buy the stock, put the collar on. If you truly had FOMO and you're nervous, but you want to dip your toe in the water on Nvidia, another way that we can do this is to go on in and do a long call spread. And a collar and a long call spread are brothers. They're synthetically the same trade as far as the risk and reward is concerned, but one is a lot less capital intensive. All right, I see we have a question or a comment or however we want to say that. And we're going to put it up on the screen here. If the stock jumps close to the short strike, would you consider rolling the trade up and out to capture more upside? All right, so let's say the stock did gap open. This is actually not a bad time to do the Nvidia trade, and that, the big thing that's been driving Nvidia has been earnings and earnings reports. So we got past that earnings report. So the gap opening is less likely, or the gap down is less likely. But if it did gap and hit the 500 strike right away, the question really is, would you just let it get called away? Would you close it out? What would be your next move? And in my scenario here is I would probably look to roll it. I do still have that deep in the money strike, and it would really depend on how fast it got to that 500 strike. But if it happened in the next couple of weeks, we got a 53-day option contract, October 20th expiration. And if it happened in a couple of weeks, I would definitely consider rolling it. Now, what's really important about that is that you can't wait. It makes it very hard to roll if the stock's at 550 and you're 50 points in the money on this call option. So you want to do something when it gets to your strike. And normally you would roll up and out. What does that mean? That means we're going to buy back the 500 strike call. And, well, I guess we can't really go out because and I'm glad that just triggered that. This isn't a covered call scenario. So we'd have to buy back that call and actually sell something higher on that position if you thought Nvidia was going to keep going. So we'd stay in that same expiration. I can't go out to November, because if I go out to November, I'm no longer covered because my short option contract is being covered by an option contract that would be expiring before the short one. It's not considered covered. So in that instance, I would buy the 500 back and then pay a small debit to roll to the 510 or the 515. That's where the strike would be at. So thanks for that question. And actually, I'm sorry that it sparked that notion that I can't roll out. So if I want to roll out, I have to take the entire position and move that and roll that. So I would have to buy back the 430, or I'm sorry, buy back the 500 to close, sell to close the 430, and I'd have to move out to November and adjust it accordingly in that scenario. All right. Any other questions that we have? And we're right at time. All right. So that's it for this episode of Options Guy TV. Just interesting trade, Nvidia. A lot of people are, gosh, just neighbors, friends, people. A lot of people are talking about it, and because of that, that makes you nervous too. Kind of the shoe shine boy story from way back in the day. So if I did not have a position in Nvidia, this might give you an opportunity to use options to limit your risk and still dip your toe in the water. Thanks for coming. Please click subscribe, hit the bell, and give us a thumbs up. And we'll see you this Wednesday for the next edition of Options Guy TV.